It's the final video in our series, and it's possibly the most exciting one. I'm kidding, obviously. You clicked on this video knowing it's about tax benefits. But even if it's something kind of dry, it's something all of us should know. And in the end, it's one of the biggest reasons to invest in multifamily. To start, let's just reiterate something we covered in a past video. As a passive investor, you share in all of the gains and paper losses of a property. If you own 5% of a deal and the deal as a whole has a paper loss for the year of $1 million, you'll receive 50,000 of those losses. So let's cover what those losses are and how you might benefit from them. But before we start, yes, again, I need to put out a disclaimer. Don't rely on anything within this video as tax advice. I'm here just to speak to you to introduce some ideas and concepts, not to give you advice or even the full picture. Consult your tax professional to gain a clear understanding of how these concepts might apply to your own situation. Now that that's out of the way, let's talk about depreciation. When it comes to residential property, no matter what the size, the asset is depreciated over 27 and a half years. That's a pretty odd number, but that just means that every year in the eyes of the government, the value of an asset decreases by 127.5% every year. We're not actually realizing this decrease from a property's value, but the IRS requires you to take depreciation as a loss when reporting taxes. Because this loss isn't actually affecting our income for the year that it's realized, this is called a paper loss. The only place you see the loss is on paper. Now, the great thing about multifamily properties is that we can take this a step further. We can do what's called a cost segregation study. A cost segregation study is fairly simple. Look around the room you're sitting in. There are outlets and lights, paints and flooring, all kinds of odds and ends that are part of the property. Well, an outlet isn't a residential property, right? It's just an outlet. So what's it considered? It's considered personal property, and personal property depreciates at a different rate. In fact, this category depreciates over three different rates: 5, 7, and 15 years. What a cost segregation study does is list out every single thing in a building. Each item goes into one of those three buckets: the 5-year bucket, the 7-year bucket, and the 15. Then we take the value of all of those buckets and depreciate the total over the course of its corresponding number of years. This means that much more depreciation is taken at a much faster rate. If we have $1 million worth of 5-year personal property in our investment, we would see $200,000 of paper losses just from this bucket alone. Overall, taking a step back to the whole building, outlets, and all, the total depreciation remains the same. We're just able to front load a lot of that depreciation into the first few years because of the cost segregation study. Another incredible feature that multifamily can bring is 100% bonus depreciation. Introduced in 2017 as part of the Tax Cut and Jobs Act, bonus depreciation allows us to take 100% of the value of eligible assets, things like new air conditioning units or ovens while remodeling kitchens, and receive 100% of the total depreciation in year one. So if we buy a $500 washing machine, we can immediately take a $500 deduction. But we're not just buying one washing machine, we're likely buying 100 for all of the units of the property. That's a $50,000 paper loss as soon as we buy the new equipment. This concept was introduced to help stimulate the economy. It's slated to expire at the end of 2022, at which point the bonus begins to drop by 20% every year. So 80% bonus depreciation in 2023, 60% in 2024, and so on. Hopefully, Congress decides to renew this policy because we're big fans. And so, what does this mean for you as a passive investor? Well, the theme here has been high paper losses early on in the life of an investment. This often results in losses of more than 50 cents on the dollar. These losses can be used to offset any income or gains from the property. If you don't end up using all of your losses, you can roll them over to the next year and the next, often offsetting meaningful portions of your investment returns. And if you're really strategic, you can pursue real estate professional status. Fair warning, this isn't really for most, but for those who can achieve this classification, whether it's themselves or a spouse, they can use 100% of these paper passive losses that we just discussed to offset active income, like a W-2 wage. People like real estate agents qualify for this classification, and it's the key way that many people in the multifamily industry are able to fully offset their federal income obligations. If you happen to spend nearly all of your time within the real estate world and are curious if you qualify, I'd highly suggest researching it a bit more or asking your CPA. And that's all we have for you on tax benefits. If you do have any questions, please reach out via the contact page.